Well, welcome back to the Stock Market Brief Show. What an exciting day in the markets today. We had ourselves the first down day after 8 days of pretty much straight up price action. Today's candle engulfed the last three prior trading days on some distribution type volume. It could be a potential bearish signal. We're going to talk about that on today's Stock Market Brief Show and why everyone's calling that the recession is here. We had Jerome Powell talking today. We had a bond auction today. All kinds of exciting stuff. So let's go ahead and hop into today's episode. Well, people, welcome back to the show. We're going to start off here with some of the news stuff that's been going on. Powell says that the Fed is not confident it has done enough to bring inflation down. Some hawkish remarks from the Fed, including some cuss words today, to telling people just to close the effing door. Interesting stuff. And now let's take a look at what his speech entailed. There's a couple of things that I wanted to highlight that are very hawkish. We are attentive to the risk that stronger growth could undermine further progress in restoring the balance to the labor market and bringing down inflation, which could warrant a response from monetary policy. They also mentioned that if it becomes appropriate to tighten policy further, we will not hesitate to do so. He also brought back at the very end over here of this paragraph, we will keep at it until the job is done. And he's been using this on occasion, and every once in a while people catch on. But if you remember, the keeping at it part is, if you look at this book from Paul Volcker, and he talks about keeping at it, seemed like a big reference from that book, which we discussed on episodes when they started the tightening policy. Now, after the remarks of Jerome Powell, the 2-year bond shot up quite a bit. The 2-year yield shot up quite a bit. As far as the Fed watch tool goes, nothing really changed over here. It still looks like rates are going to be held till June of next year. Fed fund futures, that is, and then a drop into June. So we're at 525 to 550 right here. And it says that we're basically, the probabilities that we're going to stay there until middle of next year. Obviously, unless something changes. The 30-year bond auction, absolutely horrible today. Ransomware attack on China's ICBC disrupts the treasury market trade. So it's just all kinds of weird stuff taking place today. If we take a look at the 10-year yield overall, from just an absolute perspective, a technical perspective, it is bouncing from where? From the lower trend lines that we kind of discussed of this channel. So it's still holding up within that channel. As the 10-year yield bounced up, well, bonds got clobbered today, down 2.3%. We're still seeing massive volatility over here, and you could see that by looking at the MOVE index. It's still holding relatively high. So bond volatility is relatively high. If you look back, it wasn't here. Since prior of all, 2022, 23, it wasn't here since the pandemic. And then prior to that, we saw a spike in 2013. And then before that, we had 2011. And then before that was the great financial crisis. So bond volatility still remains high. The dollar shot off to today, which we've been talking about, these divergences, right? Building in the market to be aware of, right? That's what we do here. We try to prepare ourselves for the next move in the markets. And the dollar started bouncing up. And we had that down day there in the S&P 500. We'll talk about, key levels to watch momentarily. Copper, right? Copper's been falling, had a little bit of a bid today, but overall an indecision candle with quite some volatility. And we talked about how this negative divergence might be giving us a sign that the S&P 500 very well may pull back. It wasn't just that. We had smart money versus the dumb money, right? We talked about how high yield the high yield corporate bond ETF was putting in lower highs, while the SPY was putting in higher highs over here. And sometimes when these divergences occur, you can see potential turning points in the market. And we talked about the bullish divergence, right? This was at the before the big rip of the rally. And then I just wanted to call out the negative divergence that was forming, and the SPY backed off a little bit, playing out through that divergence. And the reason why I show this is because if you are aware, high yield bonds and the S&P 500, the correlation is almost like a 1-for-1. Like most of the time, it holds its 15-day, 30-day, 90-day correlations all above this line here, the 0 line, right? So that means it's a positive correlation. Very rare do you see slips underneath to have a negative correlation. For the most time, price action stays in a positive correlated state. So if you want to see turning points, well, this is one way of doing it, going into smaller time frames, and you can potentially see subtle divergences that play out. We also mentioned the equal weight, right? Equal weight S&P 500 versus just the SPX, which is cap weighted. This has been falling, not reclaiming its 50-day moving average, and the S&P 500 kind of was just grinding higher, and this typically leads, this tells me that there's poor breadth in the markets, and if the other mega cap stocks, don't perform, and the small caps don't perform, or, as an equal weight basis, you can see down days in the market. So many different aspects gave us warning that we're going to see a potential pullback at some point. It wasn't just, 8 days straight up in the row, and we said now it has to go. There was things beneath, peeking behind the curtain that were taking place. Oil over here definitely sniffing something out, right? We saw a little bit of an uptick today. Also, a lot of volatility. Was all the way back up to 77, came all the way back down to close under 76. This is bear market territory for oil. From its last recent peak, it went down 24% in just over a month and a half. Well, just over a month, which that's a large move in a short period of time for the price of oil. So we'll continue to monitor and see what that happens. Keith McCullough from the Hedge Eye said that the recession is here, amongst other people saying that, and you can look at a lot of different things to really kind of come to that conclusion, which we've been talking about a lot. I mean, if you look at loans and leases, so think of this as credit growth. Credit growth has been contracting here for quite some time, and if you date back all the way to 1975, as much as data as I can pull on this, you'll see these gray shaded areas, and those are all recessions. And you'll see leading into these recessions, you typically had a period of credit growth contraction taking place. Not all the time does it mean that credit growth leads to a recession, but every recession prior to it or leading in it, there was credit growth contraction. You can also look at the steepening of the yield curve taking place over here. It's still in uninverted territory, but many times where we get uninverted and we start steepening back up, you go into recession, steepening back up, go into recession, steepening back up, recession, steepening up, recession, steepening up, recession, steepening up, recession, and then over here we're uninverted. But if you zoom in on this, here's the 10-year, 2-year yield curve. You can see the zero line, how we're inverted, right? So we're negative, right? And you can see here when we go deeper into inversion, the S&P 500 rallies. But today, you can see we actually bumped a little bit on this, and the S&P 500 pulled back there ever so slightly. So if we get into an uninverted state, does that mean the S&P 500 might take a little bit bigger of a hit? We don't know. We don't have that answer. But if we look throughout history, when we do look at times like in, for example, 2019, right, the pandemic, or you go back to 2006, 2007, or even the .com, how we get this deeply inverted yield curve. And then when you uninvert, you can see volatility in the markets. When you uninvert, you see that volatility in the markets, and it can lead to a recession. But there's also another key element here, and that's the federal funds rate, right? Where are rates at during these times? Well, you can see they're actually coming from a rate hike cycle, but then something happens, something breaks where they have to start lowering rates back down. And right now, as we already previously stated, the Fed said that they're going to be keeping at it to get inflation down. And you could see here the Fed funds futures are saying that they are going to be holding rates higher, but they may drop them here in the near future. So what will force the Fed's hand to, really start dropping rates if inflation kind of stays where it's at? It's going to be an interesting ride. You can also look at something like unemployment rate. We're starting to see this subtly tick up here, and this is a lagging indicator, but we are starting to see the rise in unemployment, which is not a good thing at all. Non-farm payrolls, private non-farm payrolls. If you want to read about that, by the way, you can just download this chart deck to know what this is. I have a little description right there, but we're talking about a pretty weak report, way below consensus. That was recently reported here in November for October's numbers. We have something like, this I found interesting. Somebody said, oh my God, credit card debt is at $1 trillion. Yeah, but the percent of credit card debt relative to money in the bank near the lowest in 20 years. So basically what they're saying is, yeah, credit card debt's super high, but the debt relative to money in the bank is low at near as lows. And it says context matters. And I responded with a specific chart in this. Context does matter. And unfortunately, the chart, it does not provide it. Okay, we're checking in on basically the consumer here. Those who have money and those who rack up credit card debt are two completely different groups of people. People who have money don't typically just sit on 28% interest on their credit card debt, which that's where it's at. We're sitting at, cycle highs here on interest credit card debt, to earn only 5% on the bank. There's no reason to do that if you have the money to pay off the card. There is a reason why delinquencies are on the rise on credit cards and auto loans, despite what that chart provided. Some might call this the barbell economy. Middle class, they get squeezed, rich get richer, poor get poorer. And I was referencing this chart here, how you see a large spike in serious delinquencies for 90 plus days on credit cards. So that's not like somebody just forgot to pay their bill after a few days. No, this is 90 plus days of not paying their credit card. And this is looking from right this point to where we are now. This recent report came out. That is a huge spike, and you're starting to see a larger spike move, subtly uptick there also in auto loans. If we take a look at the consumer through another lens, say small cap stocks, which is a good view of the overall economy, what do we see? Well, we have that inverted yield curve over here. We have volatility still compressing, and rates are still on a high cycle. And we broke down, we bounced a little bit. But overall, from the highs over here from 2021 going into 2022, you can see that we have been clobbered. So it's just small cap stocks have not been holding up like the mega cap names really have been. And you can see over here, retail, right? Retail is another sector you can pay attention to. And you'll notice here, similar to IWM, when does it really go up in price? Well, it goes up in price when the federal funds rate is basically held down, right? What does this mean when the federal funds rate is down here near zero or at a lower rate? It means money is cheap. Spending happens more frequently, right? So when money is cheap, people spend more, right? Boom, markets go up. Boom, markets go up. But what happens when they start raising rates? Well, you can see here we start to flatten out, have a lot of volatility. Something happens and they compress rates down. And what do you see here? We started raising, market started falling, starting to flatten out over here so far, right? And the market is kind of just chopping around. So what will propel this right back up? Well, hey, if something happens with the Fed where they have to slam rates back down or start moving them down, hey, that could be a potential sign to start really paying attention to retail names and even small cap stocks. Let's take a look at how the S&P 500 and other indice products did today. We'll start off here looking at the 11 sectors. These 11 sectors, they make up the S&P 500. You can see down here to the bottom, XLY, consumer discretionary. I'll pull up a heat map momentarily. Consumer staples, communication service. It was just a mixed board, but what you'll notice is that it was all red on the day. Technology was kind of middle of the pack. And you'll notice here as the index products go, I mean, it wasn't too crazy of a day. The Nasdaq Composite was almost down 1%. S&P 500 down almost 1%. Dow Jones about 0.5%. Small caps once again led the decline. That's multiple days now in a row of small caps kind of crumbling down, losing some of the momentum that they had in the last since the start of this month. They're still doing good for the month overall, but if we take a look at the heat map, you can see over here in bright red, Tesla dropped 5.46% on the day. Nvidia managed to maintain its gains, but it did put in a shooting star type candle, if I remember correctly. So that could mark a potential reversal in the price of Nvidia. I thought that they were reporting earnings this next week. I think it's the week after. So apologize if I said that here. I can't remember if I did. So if we look at the S&P 500, once again, we had that bearish engulfing candle on a rise in volume. We've had these bearish engulfing candles before, and they led to further declines. So we'll see if that's the case. Remember, all we have to do really now at this point is wait to see where price goes and where strength shows up. Because as it stands, even if price were to pull right back down to here, so say 420, well, say if that marks the bottom and we start moving up, that would be a higher low in the price action, which is the first step in changing potential trend. And if you look at the S&P 500 through the lens, from dating back a little bit further, people are going to start calling out an inverse head and shoulders, right? That's just what's going to happen. So even if we pull back to around that 4,300, even deeper, 4,200, that could still represent a higher low, right? So we don't know yet, but you'd want to see strength pick back up if that's the case. Not to say that's going to happen. We could very well just do that, right? But as it stands, you want to be patient in these times, and I'll give you more tactical levels momentarily here. We do still have the buy signal active on the summation index as we've been positive now for 5 days. You can start to see it's curling itself over a little bit. We're still above zero on the Nasdaq McClellan oscillator. If I show you now the 15-minute time frame for the SPX, here is a big change that took place today as far as gamma goes. We are now back into gamma, negative gamma territory. So if you remember yesterday's video, what does that mean? It means this. It means that dealers, they buy strength, right? They buy strength, which means that you can see really strong moves to the upside. However, when selling takes place, you can see dealers sell into that weakness, creating volatile hits to the downside and upside. So it's always important to really pay attention to market conditions. And the market conditions now, volatility is going to be increased as we're in negative gamma territory. And if we get back into positive gamma territory, just so you know, what does that mean? It means that dealers sell into strength, they buy into weakness. So volatility compresses, and it's typically what you see is something like this. Okay, as far as some other levels, we have the upper daily expected move at 43.75, which would put us back into positive gamma territory as of now. Lower daily expected move at 43.19. As far as local support goes, there isn't a gamma exposure level really around us at this, of worth noting. From what I pulled as far as like the top 5 strikes. And what I'm looking at here is potentially you might find some support right where we kind of gapped up from over here at about 43.40, which was the prior gamma flip level yesterday. It changed, obviously. The structure changed. And then we have the lower daily expected move over here at 43.20, which lines up with the gap fill. And when these gaps are filled, the windows are shut. They could potentially act as a level of support. Now, if that level is broken and we go down further, pay attention to this gamma exposure level and the weekly expected move in confluence at 42. Basically, we'll just round it to 4,300 on the SPX. You'll note also we're back below a 5-day moving average. The 5-day moving average is still inclining. So to see a move, to come retest it, that's typical to happen, but you want to see obviously strength and it break back above it, get above some key levels. So just pay attention to how this kind of shapes up. If it starts to flatten out and starts to head down as price action puts in a lower high after the bounce. So the current high that I would need to take out to feel more confident would be up into this range. And you can see we're probably going to get a bounce at some point here. Make sure you pay attention to where that high goes and if it starts reflecting to create a lower high, and then we'll kind of go from that area. But remember, markets move between expansion and contraction. Right now we're in an expansionary move, moving into negative gamma territory. As far as like the week-to-date performance, we are, I believe, down on the week now, right? The week started, I think, right around here. So we're down on the week to relatively flat. And we haven't even tagged a weekly expected move as it stands, being in negative gamma territory. The door's opened for here if the selling obviously continues. So we got to be careful overall there. There aren't really too many things going on going into tomorrow other than Michigan consumer sentiment. We have some Fed speech as well. So could be, as we're heading into Veterans Day, could be a calm day overall. We'll see. Next week, though, what are the risks? Well, we have inflation data. That's going to be a big one, right? PPI, retail sales, building permits. And then we have, as far as earnings go, we have Home Depot, Target, Cisco Systems, and Walmart. This is a part of the S&P 100, so nothing crazy there. And then another thing to just put on your calendar, right? September 30th, we did the stopgap funding bill, right, to push, basically to keep from a government shutdown. And we're nearing November 17th, which the government shutdown deadline is nearing. So it's going to be important to actually mark that on the calendar. There has been some news that Republicans say that they'll settle a plan this week to avoid a partial shutdown before Thanksgiving, but we will see. I want to close out with this specific chart. This is the bottom finder right here, where it's marked out horrible breath, getting better breath. And you can see that when we get back above that 35 line, you could typically see it mark bottoms in the market when you can see we're still here in negative, or not negative territory, but we're still well below it even after this recent bounce. So pay attention to see if this thing continues to go up. That's the NASDAQ record high percent index, and we're paying attention to that 10-period EMA. That's all I got for you on today's episode. Everybody have a wonderful night.